Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby Kinzer.
And I am Thomas Doty.
And we are the FITT Show, bringing you information to help you better manage your money and hopefully increase your net worth and learn how to pass it on generationally, just not for yourself. Just so happy to be here, Dote, another week, man. This is our 44th show. Can you believe that?
Seems like it, yeah. But it's going good. And I'm in sunny Phoenix. Just happy to be.
Yeah, man. We've had some great shows last week with strategies to combat inflation. Got a lot of questions and a lot of good information that we passed out. So we'd like to thank for everybody for checking us out. And as usual, we want to say hello to all our people who are joining us. Hello, Modestine and Garnett. Always great to see y'all. Good evening, ladies and gentlemen around the world. Don't we have people on from Scotland and England today also, man? It's so good. Just want to remind you all, please make sure you click on the like button and the heart button because that actually gives us a more access to more people. They just don't let us reach people in Facebook just by all the friends that we have on our site. So the more you click on those buttons, the more we will be able to reach more people. And also putting comments is even greater. Any statements, comments, or questions that you have, or topics that you would like to cover, please join us. What's up, Joanne Skinner? It's glad to see you. We got the whole FDC family up in here, FDIC family. Glad to see you all tuning in. And also hit the share button and share it on Facebook. And everybody on YouTube, we want to expand our YouTube audience. So go out there and make sure that you subscribe on YouTube. Yo, with that, man, let's get into this crazy stock market. What's going on today?
Yeah, it's been wild, but it's kind of crazy because if you look week to week, the past week, not much has changed. The Dow was 34, about 34.8. Last week is 34.7, closed today. The market took a pretty big hit today. NASDAQ was about 14.2 last week. It's about 14.2 this week. Had been on a pretty good run until the last couple of days. Microsoft is closed at 303. I'm sorry, 308, but it was 303 a week ago. And I remember, Bob, us talking about when Microsoft was 275. And I think I made the comment, I liked it at 339, so I got to be crazy about it at 275. And I didn't buy any more. I thought about it. I'm a little heavy in Microsoft right now. I have about 600 shares. And so I wasn't looking to get any deeper, but I just knew that was a good buy at 275. Tesla had a pretty good run. It's up to 1078. A week ago, it was only at 1009. So that's up 69 points. Apple's pretty flat between 173 and 175. And Pfizer actually took a little dip. It went it's down about 51.70, and it closed a week ago at about 53.01. So it's been up and down, which is to be expected given these crazy times with the pandemic and the war. And as we always tell you, just pick good stocks and stay with them, and don't get spooked by all the volatility that's going on in the market right now. Just hang with what you got.
Yeah, dude, with my stocks, man, they've been holding, some are holding well and some are not doing as well, but that's expected in the stock market. But remember we talked about those staple stocks like Procter and Gamble and Costco and people like that sort of provide all of these products and stuff that people use every day. Well, we talked about Procter and Gamble stock. Last week was $151.08. This week it's $152.80. Now that might not be much of a gain, but if you look at the market today, the market NASDAQ was down over 200 points. But this is sort of interesting, though, that I like to share because we state on week to week the different returns. I don't know if people are following them by writing them down. But even though today that the NASDAQ was down 221 points, but for the month, from the beginning of March to the end of March, it is up 469 points. That's about 3.4%. The Dow today has been down 550 points, and that's like 1.5% down. But for the month, it's up 785 points. That's 2%. Standard & Poor's, same, down 72 points, but up for the month, 156. Now check this dichotomy, though. So then let's look at the year to date, from January to the date. Now, last week when I told you about it, no, a couple of weeks ago, I told you about it, it was almost double what I'm getting ready to tell you. But because of that good month, and just trying to show you how this market can turn around, and we're going to talk about, its worst days and its best days. There's a correlation there that we want to talk about. But the NASDAQ year to date dropped last week. A couple of weeks, it was over 2,000 points year to date. Today, the year to date, today, March 31st, it's 1,424 points. It was over 2,000 points a couple of weeks ago. The year to date, down 9%. The Dow Jones is down about 1,659 points year to date from January to today. That's 4%. And the Standard & Poor's is down about almost 5%. So it's an interesting dichotomy, though. And that's why we tell you, and today our subject is keys to successful long-term investment. And that's why we're going to get into that and tell you it's so important to understand this is for the long haul. It's not for the weakened stomachs, not for people that jump in and out, which they call a lot of people day traders that do that, who are using technical and fundamental analysis, looking at charts real time. For the novice people, it's very important to understand, and that's why our topic today is keys for successful long-term investing. Though I want to talk about the cryptocurrency market, what everybody always like for me to talk about, right? Dope. So one of the things I always said, one of the things to look at is the market cap, right? Because that tells you how many people are in and how many people are getting out. Now, a few weeks ago, the market cap was down to like 1.9 trillion. Last week, it was up to 2.2 trillion. This week is up to 2.18 trillion. So people are getting back in to the crypto market. Now, last week, this time, Bitcoin was at 43,300 some odd dollars. Today at 6 p.m., because remember, the cryptocurrency is open, market is open 24 hours a day. As of 6 p.m. today, it was up $45,723. So all your people holding that cryptocurrency, because I know some people that jumped out of Shiba, jumped out of other cryptocurrency because they couldn't stomach the loss, but it's already starting to turn around. But even though it's up 45,000 this week, today it's down about 2.5%. And it's still the number one, Bitcoin, number one amongst the cryptocurrencies. Now, last week, the market cap was at 834 billion. That's almost half of what the actual cryptocurrency market is. But this week, it jumped up to 868 billion. That means people are getting back in. Same thing with Shiba Inu. It's down, but it was down at number 15 in the ranking. It has moved up to number 14. Yeah, wow. And Dogecoin was down. It was number 13. It moved up to number 12, but it's still only, last week it was selling at 11 cents per cryptocurrency. This week is at 13 cents. But just that little 2-cent jump had it move up amongst the cryptocurrencies. So, dope. I want to talk a little bit about our subject today, and it's invested with a successful keys to investing long term. And long-term investors, the long game. We've always talked about that. We always talk about whether you want to invest to grow your savings or for retirement. When you put money to work in the markets, it's best to set it put it in there and just don't look at it, just forget it. Before you can invest for the long term, though, you need to know how much money you have to invest. And that means getting your finances in order. Just like a doctor, the doctor wouldn't write a prescription without diagnosing you first. And that's the same thing with an investment portfolio. It shouldn't be recommended unless a person has done some comprehensive financial planning. So if you get into, with some of these advisors and they just want to put you into products, no, you need to make sure you have a plan. And that plan means start by taking stock of your assets and your debts. Setting up a reasonable debt management plan on how you're going to pay that debt down, and understanding how much you need to fully stock an emergency fund. Now, tackling these financial tasks first ensures that you'll be able to put funds in a way for the long term, and not only so you won't be like pulling out money time and time again while you need it. Withdrawing funds early from long-term investment undercuts your goals. It may force you to sell at a loss and have potentially expensive tax implications. So overall investing is all about focusing on your financial goals and ignoring that busybody nature of markets and the media that covers them. That means buying and holding for a long haul, regardless of any news that you move you to try and time the market. Now, successful long-term investing isn't as simple as just throwing money at the market. And that's why me and Dope, we always talk about the market and being in and reaping the benefits. But we also say always be smart and understand your risks. So we will discuss some of these keys to help you get a handle on long-term investing. Dope, let's start with the first key.
Okay, and you just mentioned it. It's about investing for the long term. And one of the things you need to think about is if you make it to 65, you're probably going to make it to 80 or 90. So you're going to live a long time. So you need to plan on having enough money to cover you for that period of time. So you got to make sure you saved enough for retirement. And if you're younger, the younger you start, the better obviously, the better shape you'll be. And if you're a little older, you might want to start putting in a little more just to make sure you do have enough for retirement and to live a long life. So no matter what your goal is, if you invest for the long term, you need to understand your time horizon and have an idea of how much money you're going to need and how many years you have before you'll need that money, so you can make sure you're set when you get to whatever goal it is, whether it's retirement, paying for college, buying a house, or whatever it is. The sooner you start saving, the better. And the more you save, the better.
So Doug, I want to share a particular graph with people.
Yeah, and that's funny. It kind of shows you just how crazy things are. 68% of people think you'll need at least $500,000 to retire. Okay? That's what most people think is how much is needed. 68%. But the median amount of money people have saved in the age group between 55 and 64 is only $134,000. So people feel they need $500,000, but the median number of people only have $134,000 saved. That's not getting it done. So if you're in that bunch, you may have to consider saving more. And I'm not sure $500,000. What you're going to need depends on a whole lot of things, whether you have a pension, how much Social Security you get, and just a bunch, and what your living expenses are, or you expect to be in retirement, what you plan on doing with your money. So this just shows you people recognize the need, but enough people aren't doing what's necessary to meet that need. And that's one of the things Bob and I have been trying to do, to get people to understand what they need to do to get where they want to be. And you just saw for yourself, most people know the need, understand the need, but aren't working towards the need. That's where hopefully we can get you there.
Yeah, though that's what's so interesting, that you're going to hear a couple of rule of thumbs like, 10 times your salary, 4 times your salary. All those things are just measurements or benchmarks to give you an idea, but none of them are exact science. But the key is to try to have a goal, some kind of goal that you can go to, because that's what's so important in investing. Before you can do anything, I don't care if it's long term, short term, or whatever, you need to identify what is your time horizon. Though I want to talk about the next thing is cash isn't king. What do I mean by that? What do I mean by that? So there's a lot of people, though, that are into matter of fact, it says it. It's a lot of people that uh have money in cash, right? And cash equivalents like certificates of deposits still act as a safe haven for volatile markets. Don't get me wrong. But the average rate on a traditional savings account is still well below the rate of inflation. And don't check this out. There is approximately $16 trillion in cash still that sits on the sidelines.
That's
Now,
just
what does this chart tell you? This chart is taking certificate of deposit, CDs, right? And seeing it, because normally, back in the day and today, CDs, outpace inflation. So from 1980s to the 2000s, the income generated from a CD outpaced inflation. So if you look at the 1980s at the top bar, CDs, because they were paying like dope back in the 80s, man, 15%. I remember I was closing banks at FDIC because they were giving 15, 18% on CDs. They were giving 8, 9% on savings accounts. But what this is showing that the blue bar or the top bar, if it was invested in CDs, it outpaced the inflation, the bottom bar, which is green, which was the income needed to beat inflation, 5,500. But CDs was outpacing it by about $4,500, $4,400. Look at the 90s. It started decreasing. CDs were only paying about $5,000, but you needed 3,000 to beat inflation. So CDs were still outpacing. But look now in the 2000s. Now this is based on income earned on $100,000 invested in a six-month CD. The bottom one, though, shows that now you might can get $3,000, $3,310 if you invested 6 months and you put $100,000 in. To beat inflation, you had to make about 2,570. It's getting lesser though, and that goes to our point about being able to invest so that you can maximize your benefits, because that's what this chart is showing, right? It's good to have cash in volatile markets, but too much of it in one place, you're not really taking advantage of the benefits from the market. And if you're not keeping pace with inflation, which is now approximately 7.9%, and if your CD is giving you 2%, 3%, just think about it. You're at a negative. You're not even keeping pace now with a CD.
Hey, Bob, nobody's getting 2-3%. Most of the rates are below that. I
Right.
think this chart shows you how people just become victims of what they've done in the past. And it kind of worked in the past, but it's not going to work now. With interest rates close to zero and inflation raging right now, it's a loser's game to be in cash. It really is. But you can see people are a victim of habits or what they've learned and they've heard, put your money, be safe, put your money in a savings account, don't risk it in the stock market, blah, blah, blah. But you're losing money if you have money in a savings account right now and you're comparing it to what the interest rates are doing.
And this is the thing about the risk, though. There's two risks. There's actually two risks. The risk of you losing money and the risk of you not having no money when you get older. They always talk about the one risk, but there's actually two risks involved.
Right.
And that's why we always try to say, it's kind of important to look at other alternatives. And you got to know your risk too, you all. That's so personal. You need to understand your risk. But though we're not saying cash is not good, because you definitely need to determine the amount of cash that you need to have in an emergency fund. And me and Dote said this a couple of weeks ago with the war and things like that, the Federal Reserve changing the fund rates. It might be good to have a little cash in your house in case things get so tight that you go to your ATM machine and you go to pull some money out. And I'm telling you, Dote, I explained this before, during the economic downturn, what they call the Great Recession, that there was a chance you were going to go to your ATMs where banks couldn't lend between each other, and you wouldn't have been able to get any cash out. So cash isn't always king.
Okay. Next, let's talk about the power of dividends and compounding. And we keep stressing compounding. We talked about the rule of 72s. And that's simply you take 72, divide by the interest rate. That tells you how long it takes your money to double. So if you are averaging, let's say 12% interest or 12% return, your money will double in 6 years. And so it talks just the importance of that. The other thing that people miss out on is reinvesting dividends. And a lot of companies have different dividend policies. I think I've told you I bought Pfizer because they pay a decent dividend, and I expect it to grow. But let's give you an example. If you took $10,000 in 1970 and invested it in a stock and did not invest the dividend, the green bar shows you how much you would have. I think that's 408,000, Bob.
Correct.
That's what you'd have, which isn't chump change, but still, if it's 15 years, you'd have 408,000 bucks. But had you reinvested the dividends, you'd have about 1.9 million.
8 million.
1.8 million. I was rounding. 1.8 million. And that difference is compounding and reinvesting the dividends. And some companies pay pretty hefty dividends. Some companies don't. All that is money that they give back to their investors. Some people, especially fast-growing companies, and it used to be most of the technical companies didn't pay high dividends because they were using all the money that they made. They were using that to grow. But as companies mature, they start saying, okay, let's pay our stockholders, let's increase the amount of dividends. And those are the stocks that if you reinvest, you can make some serious change. Again, I think I told you I bought Pfizer because their dividend is slightly over 3%. And that's in addition to any market growth or any growth in the stock that's anticipated. And I'm expecting Pfizer to grow. But for me, it was more of a dividend play. I'm getting a higher interest at 3% than I'd get in a savings account at less than 1%. So that was the reason for buying that. You just can't underestimate the power of compounding and how your money can grow exponentially by reinvesting your dividends, looking at your time frame, and the value of compounding.
And Dope, what's so interesting, most people understand the concept of compounding interest, but they be sleeping on compounding dividends. And as you can see from that chart, they can grow just significantly so fast. The difference between 400,000 and 1.8 million. I mean, that was very eye popping. So next key to successful long-term investing, I'm going to talk about staying invested matters. We talk about the long haul all the time. Once you establish your investing goals and time horizon, choose an investing strategy and stick with it. It's great to have guidelines. You have to do what works for you, no doubt about it. Especially important it is to choose a portfolio of assets you're comfortable with so that you can be sure to stick with your strategy no matter what. But by missing some of the market's best days investors can lose out on critical opportunities to grow their portfolio. Market timing can have devastating results. 7 of the best 10 days occur within 2 weeks of the 10 worst days. The second worst day of 2020, which was March 12th, was immediately followed by the second best day of the year. And that's that's interesting, isn't it, though? But I want to show a chart that sort of explains this better. It's amazing, man. So this is talking about staying invested. So returns on a $10,000 investment into the Standard & Poor's on January 3rd, 2000 to December 31st, 2020. On the left side, it shows if you stayed in the market, even with the worst days, your investment, $10,000 fully invested, would have grew to $42,231. And that's a 7.47% return. But on the right, it's showing if you miss the 60 best days within that time frame of 2000 to 2020, you would have only missed, you only would have made $2,441, and your return, you would have had a negative return of 6.81% return. If you just missed the 6 best days compared to the fully invested $42,231 versus $2,441. Though this was kind of devastating, but this just goes to show you with people who try to time the market, it's hard to do. That's why we say it's the long haul. Stay in there, have ebbs and flows. But the longer you stay in there, the better it works to your advantage.
Right. It's impossible to time the market. That's for sure. That's for sure. Another issue we want to talk about is avoiding emotional biases by sticking to a plan. Okay. And when we talk about emotional biases, we're saying investing in things that you've done just because somebody told you it was a good idea. You didn't do the research. You didn't find out what you should have done. You didn't look at other alternatives. You didn't look at what else may be available in order for you to invest in. Show the chart, Bob. The U.S. market only accounts for 1/4 of the total global capital market. So, to say that another way, there's 75% that most people are invested in. 78% of people in the U.S. are invested in U.S. equities only. And so think about that. That's only 25% of the market. You're missing all types of other opportunities. And we talked before about how the U.S. market might run counter to, say, a market in Europe or a market in Asia or a market in South America. So there's all other things you ought to look at. There are other opportunities that are available that might run counter to way the U.S. market. This will help you get a little more diversification too. And it's all because you stick to what you've been used to or what you're familiar with. 84% of people in the U.S. invest in U.S. bonds. Okay. That's a hunk of people who are invested in a very small part of the total global market. So avoid those emotional biases of wanting to stick to a country. Do your homework, learn about it, and invest in other things that might help you diversify your portfolio and also grow your portfolio.
That's very important, Doug. Doug, I just want to, as in our point in our show where we have a shout out, because we just want to let people know how much we appreciate them, tuning in. We got Maddie Ford, another FDIC faithful, my main man, Brett Murray, Joe Finelli. Joe worked on the asset side at the FDIC, and on the Division of Finance side, and he knows a lot about taxes. So we got some experts on here too, though. And my man Melvin Tucker, my frat brother from A5A. Hello, Sherry. Always good to see you. My main man Juan Holcomb, Christine Diane, Rodney Madison, my sister Linda, my older sister. I don't want to say older. She go, why you say that? My older sister Linda Sy, and oh man, and we got Mark Clay, another accountant, a CPA though on here, and my little brother. I call my little brother, Carl Chapman. So we've got a lot of good people on here, though, and we thank you all, and thank you for sharing. And make sure y'all continue to hit that like button and heart button, and keep putting comments in there so it give us traction. Though, I want to talk a minute about another key tip to successful long-term investing, and that is volatility is normal, but don't let it derail you. Now, plan on riding out volatile markets in periods, because pullbacks, what they call, happen, or what they call corrections happens. They say usually the market is about 10 to 15% is corrections, like stocks like overpriced, they overstating their earnings, so they usually flatten out, and you see losses, but they actually just getting to what the real price and value that they should be. And that's what it means, pullbacks can happen. Crashes happen 20%. Usually if it's more than 20%, they consider that a crash. But after every crash, they've come back. On average, the market suffers a double decline every year, on average. But interesting, though, check this particular chart out. I think this is just, man, mind-blowing. And just over the last 47 years, right, the market ended in positive returns 76% of the time. And if this is not a example, and remember, as all stockbrokers and financial advisors say, past returns are no indicator of future performance, but history does tell us a little bit. And over 41 years, though, it's ended in the year has always ended in 70% in positive returns. So for the people who, can't stomach the market, afraid of the market, because that's what I believe most, mainly Black people, we are risk adverse, and it has a lot of reasons why, because a lot of times, we don't have that money to be able to lose. We have lesser incomes, and then we have sometimes worse spending habits on buying stuff instead of buying appreciating assets. But yeah, this chart is very telling, though. So on you, though.
I'm getting a bunch of static. I don't know why. Now we're going to talk about a little bit about diversification. It's kind of hinted at this a minute ago, Bob. The spread your portfolio across different asset classes allows you to hedge your bets and boost the odds that you're going to be holding on to a winner at any given point in time. Now, Bob and I pretty much agree. Nobody's going to pick all winners, okay? And the best way to get there is to make sure something in your portfolio is winning. Because, people can talk about, oh, I average 30% in my portfolio. That probably doesn't happen that much. And if you can make 7, 8, 9% a year on average, you should do okay. And the best way to do that is having a diversified portfolio, having stocks in different asset classes, having stocks in different regions, different segments. You may have some technology stocks. You may have some industrial stocks. You may have some automotive stocks, like Bob keeps talking about buying Ford. But I don't think he's convicted yet because he hasn't bought it. But you need to have some diversification, which is going to help you make it through rough time, through volatile times, because everything doesn't do good at one time. Everything doesn't do bad at one time. If you've got a bunch of good stocks in your portfolio, something's going to be keeping your average up in that 8, 9, 10% average return range.
Right.
So make sure you think through your portfolio, assess your risk, make sure you're comfortable with the risk, and move forward. And we've talked about mutual funds, index funds, uh, exchange traded funds, EFTs. And just an example, you think about all the craziness that's happened in the last, I think, 15 years. A well-diversified portfolio still averaged 6.7% a year. If you can get that every year, you should be able to meet most of your investment goals. On average, 6.7. That's not bad. And you'll hear people talk about, oh, I made 10, I made 12. Probably not true over a long period of time, okay? Because you're going to have some bad years, especially if you're picking things that go up a lot. Nothing goes up forever. So try to get yourself a well-diversified portfolio. That's one of the keys to successful long-term investing.
Yeah, a bunch of people said you were sounding like Grady though, because you're static in your voice.
Yeah, I don't know what's going on there.
Yeah,
Not
but
sure.
people are hitting us up talking about what's up with Dope's voice. I'm like, is he trying to be sexy? I mean, we got all kinds of
I'm
statements.
going
We
to
got
hop
some
out.
funny people.
I'm gonna go out and go back, come back in.
Do that. So while Dope is going out and coming back in, you all, I want to talk to you all about when he talks about diversification. Uh, that can be done enough. But got a question. One of the questions was, which talk about the electric vehicle charging statements, and the electric car charging. We talked about the supercharger stations that are a couple of companies that are investing in the superchargers for the entire American electric vehicle market. And are you back, Dope?
It sounds a little better.
Oh, much better. Hey, Dope, we had a question. Said, can we talk more about the electric vehicle charging stations? They just want to know a little bit more about that since we talked about that a couple of weeks ago. And what we were saying that a lot of people were thinking about talking about buying a car, but a lot of charging stations companies are coming up. One is OZOP, OZPO, and OZOP Solutions. They are a company that's building and creating supercharger stations. And we were just saying that some people should, consider some of those the batteries the charging stations are going to be charging the cars. That might not be the bad investment. But so that's what we meant for Maddie, who actually asked about more about the charging stations. Just want to throw that out there, Dope.
Yeah, and well, the other thing too, and it's kind of weird that there's nothing universal, and that like Porsche came out with their electric cars, but you can't charge your Porsche at a Tesla charging station,
Right,
which to
right.
me is just crazy. And for a while, a lot of municipalities were having free charging, but now it seems like more locations are charging for charging your car. And the big drawback for me, I think Bob, you mentioned this, was how long it takes to charge your vehicle while you're traveling. I mean, if you're doing most of your travel from home, you simply pull into your garage, and you have they've got it now where you can even charge it I'm sorry, without wires. Okay, wirelessly is the word I was looking for. You can charge wirelessly, so you don't even have to plug it in. But in most cases, you have to plug in, and you're okay. You get a full charge overnight. But if you're traveling, you have to know where the charging stations are. And what was the average time it took you to charge, Bob? If you went down pretty good in your
It went from DC to Miami in a Tesla 3. And the average charge in town, because we would take it as low as 19 miles left to charge to 240 miles, took between 30 and 40 minutes.
yeah, that's a consideration. So me personally, I'm waiting until that time goes down, and the range. I just drove from Cleveland to Charlotte on a tank of gas. I filled up in Cleveland, didn't have to fill up again until I got to Charlotte, and it's about close to 500 miles. And I'm not sure. There's only one electric car that can do that now, and that's the Lucid. And the particular model that has that 500-mile range is, I think, like $180,000. So I'm waiting for that stuff to improve, the network of charging stations to get more more popular, and that's when I'll start looking electric.
Well, and a couple of comments about the charging stations versus Tesla. Tesla's smart because this is what happened though. When we pulled into the Tesla charging stations, they had at least 10 to 15 bays, and they always never was a problem with us getting a bay. But I look at the other charging stations with other cars, and they might have 2, 4 at the most, and was always filled. So Tesla, essentially, because it seem like they're losing out on having other cars to charge. But on the other side, they have that exclusivity where, for your car, you can all the way down there. It took us 24 hours, though. We never had a problem pulling into a Tesla charging station. Now, Modestine said you need to watch out for those charging stations because they have the tendency to catch fire. Now, I heard that too, but I also heard, Modestine, that was some propaganda out there trying to, the combustion cars, the regular gas cars, that those people were putting out that kind of negative stuff that the Teslas were catching on fire and all that kind of stuff. That was definitely a myth about the Teslas catching on fire, like 1 or 2 did, and they spread it all the way around. So I don't know if that's just the competitors with the regular gas cars putting out negativity. But I mean, that's something to be concerned about. Yeah. So just wanted to make that comment on that. Dope. So Dope, let's bring it home with our takeaways for today. So we are living longer, no doubt about it. They said if you live to be 50 nowadays, it's a 50-50 chance that you're going to live to be 100. They're showing that people are men are living longer, women are living longer, and always the women's rate, life expectancy is always longer than ours, though. I don't know what's up with that. But we're living longer, so plan for it.
Yeah, number 2, pick a strategy and stick with it. Pick a sound strategy and don't be changed by market volatility or somebody whispering in your ear about a hot stock. Pick a sound strategy, stick with it for the long term.
Diversify well for successful long-term investing. Diversification is the way to go. Another term for diversification is don't put all your eggs in one basket. And if you do that, it shows over time you're going to have some winners, you're going to have some losers. But if you invest, with sound strategies, you can balance out by having it being diversified. You may have some losers, you have some winners, but the goal is that when it nets out over time, over the long haul, you should be ahead than just being in a savings account.
And we can't stress this enough. Buy and hold for the long haul. We talked about before how compounding can be so beneficial. Whenever you can increase your time horizon for saving, you will reap the benefits of compounding, and your money will grow exponentially when that happens. Also, take advantage of that. Don't forget about the dividend reinvesting. If you buy a stock through a brokerage firm, make sure you click the box for reinvesting your dividend. But buy and hold for the long haul.
Just want to give a shout out to our frat brother, Alpha Rob Robinson. Thank you for checking in as always, my good brother. Though we had another good show, a lot of people on, a lot of good questions. Please keep sharing this with other people, you all, because we're not just trying to give you this information for yourself. We want you to share it with your family members, your friends, church, your community, faith-based organizations, because we only know what we know. And I know I grew up though. I didn't, we didn't even really have an insurance policy. My mama didn't have, but back in the day, that was most people's investment. Wow, guess what that was?
Sound
That
like
was
you have a fire alarm at your house.
no, that was a tornado alert. It
Oh,
just came on my phone. Good lord! But but no, 44% of the people in America investment is mostly their house. And that's fine to have a house, but you need to diversify and be able to take advantage of the benefits that are out there for you to sustain and create wealth and increase your net worth. So, with that dope, had another good time. Any closing remarks?
no, I just think we hit on the point of long term. You got to think long term, and you got to put some time in to this part of your life. You think about all the time you spend doing other things, and everybody can tell you about the latest TV show and who said what about Will Smith and who said what about Chris Rock. Take some time and put that into your investment life. It's a huge part of your life, whether you want to admit it or not. Put the time in, get on a path, and stick to it.
Hey, Doe, did you hear the new breaking news that next year who they're going to have hosting the Oscars? They said they're going to have Mike Tyson. Oh, Doe, before we go, I want to have this conversation right you real quick. We got a little bit of time. We're not going to. Had this conversation with a good friend of mine, and he said, Bob, y'all, I watch your show, y'all talk about investing and all that. He said, but I'm okay. I'm not trying to take on no more risk. I'm retired. I'm okay. I'm not, filthy rich, but I can do what I want, go what I want, take trips on, play as much golf. So why should I even worry about investing in, the stock market, or I'm okay? Do you have any response to that?
And if he's happy and that's where he is, then more power to him.
Good
That's
point.
a little bully for you. But for me, one, I don't know how long I'm going to live. I'd like to leave something for my kids. I hope they're not listening, because I always joke that I'm gonna spend every penny that I have, and that I'm gonna be on my deathbed ordering non-refundable stuff from Amazon. But
Non-refundable.
actually, that's not true. So I'd like to leave my kids something, and I don't want to say it's easy to do, but it doesn't make any sense not to take advantage of that way of thinking. I look at every business transaction I make and try to minimize the cost and maximize the reward, whether it's a credit card, whether it's buying a car, whether it's how I rent a car, no matter what I do. So I'm looking to maximize. And that makes me happy. And if your friend's happy with where he is, and I hope he has enough to sustain him for however long he lives, I hope he lives forever, then good for him, because he's not worried about what the market does. But
Right.
if you invest for the long haul and you listen to some of the things we tell you, like don't invest money you're going to need in the next 3 years, okay? You can take all that into account and earn more money. And that's what I'm about. And the conversation, a lot of the things we talk about is not for people like him. That, remember when we start talking about doing this, Bob, my son, who just graduated from college, it just kept making the point to me that a lot of his friends don't know the things that he knows from having been around me and his mother, who know those things, who've told him those things. And a lot of people just don't know. And I'm not saying I'm anything special, but after getting a degree in accounting, getting a master's in business, getting a CPA, I learned a lot of those things. And then working in the financial field for 40 years, I picked up a lot of things, and a lot of people pick these things up at their dinner table, where a lot of people I know, there weren't no conversations like that at the dinner table. So we're trying to pass along knowledge, and we're not saying everything we pass along is for everybody, because it's not. But if you just pick up one or two things that can help you earn more money, or be more, uh, handle your budget better, or figure out where you should invest, or learn something about where to invest, that's all we're trying to do. We're not looking for any financial gain out of this. We're just looking to pass along knowledge. And if your friend's happy, more power to him.
And that's a very good point, though, because it's all an individual thing. We always talk about that. We share our personal things just as an example of things you can do, but not that we saying it's for you. We just trying to show you that we, walk the walk and talk the talk. We ain't just talking stuff. We actually taking the action, because knowledge is power, but action breeds success. And you're right, Dope. Everybody has their own personal thing, but just remember what I said about the two risks. One is losing your money, and the other one is not having enough money when you're older. That is a risk.
That's for
And
sure.
no one knows. No one knows. We get it. So anyway, Dope, thank you, man. I just wanted to share that with you. I want to say hello to Louise Spriggs, one of my good friends. We went to UDC together. She used to whip up on me in ping pong and volleyball. And Michael Wolford, what's up? Woodrow Wilson Tigers. They just got rid of our name, though, of our high school, because it was named Woodrow Wilson. It is now called Reed Jackson, by Vincent Reed, who was one of these top Black superintendents of Washington, D.C. schools back in the 70s. And Edna Jackson, 1950, she was the first Black teacher at Woodrow Wilson High School. By the way, Woodrow Wilson High School in D.C., when I was going there, was one of the last public schools that had white people. And we took it over, about 90%. All white people started taking their kids out to the private school. When they said, there goes the neighborhood, they said, there goes the school. But it's now named Reed Jackson. Edna Jackson was the first Black female teacher at Woodrow Wilson High School in Washington, D.C. More power to her. Dope. Another great show, man. Love you, man. Let's look for number 45 next week.
Okie doke. You take care. I'll be
All
yelling
right.
at you.
Peace, everybody. Make sure y'all share this and go out and subscribe on YouTube.